Welcome to the Commercial Real Estate Academy podcast, the podcast dedicated to simplifying the commercial real estate industry for the masses. Each week, we sit down with industry experts to dissect the many facets of commercial real estate and extract valuable lessons you can apply to your business. Whether you're a new or seasoned business owner or investor, the Commercial Real Estate Academy podcast will be your go-to resource for all your commercial real estate needs. Now, here are your hosts, Raphael Collazo and Jeff Walston.
Welcome to the Commercial Real Estate Academy podcast. I am your host, Raphael Collazo, here with my co-host, Jeff Walston. How's it going, my friend?
It is going well. Finishing out the weekend strong and ready for the work week. What about yourself? How are you doing?
Same thing. Yeah, this week's going to be quite busy, and then I'm going to be leaving for a conference in Denver, Colorado for the weekend on Thursday. So just trying to get everything ready to go before I head off to this conference.
That's exciting to go out and get away for a bit.
Oh, for sure. Yeah. And I'll get to meet quite a few people. I love now that COVID's kind of slowed down a little bit. Obviously it's still present, and we're trying to be cautious, but it's really great to be able to get out there and now kind of have some semblance of normalcy, so.
Absolutely. And speaking of excitement, I'm excited to announce Ben Swarts. He's the founder of Capital Gain Tax Solutions, and how that he has an alternative to the 1031 exchange for your investment portfolio. And it is called a deferred sales trust. And in an episode, we go over several steps and dive deeper into what actually a deferred sales trust is and how it's alike, but not like a 1031 exchange. He walks us through an example of someone that he's actually helped through a deferred sales trust. It was just a little thing to touch base on that. It was a primary residence, and they were going to have to pay a lot in taxes. And since 1031 exchange wasn't the quite right fit for that, they're actually going towards this deferred sales trust to actually push off taxes further in. And so I know Brett is going to be sharing a lot of ways that this can actually help and tax implications that you can do with the income produced. So do you want to say anything, Raphael?
Yeah, I mean, I think you did a great job explaining. Again, they're going to dive deep into exactly what a deferred sales trust is in the podcast, but just know that it's an alternative to the 1031 exchange, because a lot of people, when they try to execute a 1031 exchange, feel that it's very rigid, meaning that you have to hit certain deadlines, and then you're almost forced to buy something at the end of that 180 days, even though the market may be oversaturated, very expensive, whereas while executing a deferred sales trust, you can essentially get the best of both worlds. So hopefully you guys gain a lot of value from this episode, and without further ado, let's go ahead and dive right in. Hey, Brett, how's it going? It's good seeing you, man.
Raphael, I'm doing great, and glad to be here with you and Jeff.
Yeah, for sure. You're located in California, is that correct?
I am, yeah. Northern California, kind of the Sacramento region.
Awesome. Yeah. So I have a bunch of buddies out there. I went to Arizona State, so I have friends in San Francisco, LA, all over the place. So really beautiful area. So first off, we're really thankful to have you. And when we first dive into these interviews, we like to learn a little bit more about the person that we're interviewing. So you could tell us a little bit about yourself, what your background is, what got you interested in commercial real estate.
Absolutely. I grew up in the kind of the Bay Area, Silicon Valley area, East Bay of San Francisco area. And I learned real estate at a young age. In fact, I grew up building houses with my dad, owning rentals, learning about cash flow and being an entrepreneur, being a business owner. And fast forward, I knew I wanted to have a lot of margin financially in my life and do something in real estate. Didn't know what that was going to happen or how that was going to happen, but I knew I wanted that to happen. So I go to college and I studied business and a couple other things, as well as played basketball. So I was very competitive. I was able to play that in college as well on scholarship, which was fun. And then took an internship at a place called Marcus and Millichap, where I learned kind of how to do the investment real estate brokerage world, multifamily. And as a part of that journey, it wasn't always easy though, because in 2006, things were going really well. And then in 2008, everything hit the fan, and we went from making a little bit of money to like nothing overnight. And so like a lot of people who are in the commercial brokerage world at that point, you had to adapt and change and try to figure out a way to add value and stay in the business. And so my wife and I are newly married at the time, baby at home, and we had to find out how to cut expenses and keep the dream alive. And so by nights and weekends, I worked Cheesecake Factory, and by day I'd make cold calls helping my clients negotiate with banks who are also going through a big struggle, which was what? They had overpaid for properties via the 1031 exchange, had too much debt, too much liability, not enough liquidity, and they knew they were overpaying, but they felt trapped by this thing called capital gains tax. And so that began the journey of capital gains tax solutions as I learned about deferred sales trust. Fast forward, I just coach and train people how to do this, and most people don't know how to do it, and I'm sure we're going to talk about it now.
Oh, for sure. Yeah, no. And it's definitely one of those strategies that I'd love to learn more about. I've heard of it in the past, and usually what's projected to real estate clients in particular, I'm in the brokerage world as well. Everyone's saying, well, once you have a property for a period of time, you should perform some sort of 1031 exchange. But like we're going to be talking about today, there are other strategies out there that can be just as effective, if not more effective, depending on what your goals are. So
you nailed it.
Absolutely. And I can relate to building houses with your dad. I did that at a young age as well, Brett. So, but I'd like to dive further into the deferred sales trust. Can you elaborate on that and for us listeners and viewers out there?
Yeah, first of all, what is a deferred sales trust and why would someone need it? And first of all, it's not a 1031 exchange. It's also not a Delaware statutory trust, which is also DST, which oftentimes people get confused and they dismiss it thinking they already know what this thing is, right? A deferred sales trust is basically an installment sale. It's based upon IRC 453, which goes back to the 1920s. It's a tax law which says, like, if Jeff and Raphael owned a property, they can carry back paper and become the bank, and therefore they can defer what they haven't received yet. And so think of it like an installment sale. It's just we're adding this trust and we're asking the buyer to cooperate. And when we do it in that order, we essentially create an opportunity for you to defer tax, have liquidity diversification. The best part, though, is have what's called optimal timing, because our parents taught us to sell high and buy low. They didn't teach us to sell high and buy higher 180 days later in a low inventory, low cap rate, little to no cash flow, little to no forced appreciation deals. And so what we found in the 2008 crash was just that. People were feeling like they were forced in 04, 05, 06, 07, and all of a sudden the music stops and they're left with properties that they didn't necessarily want to buy. And I liken it to Blockbuster versus Netflix, right? Do you remember Jeff and Raphael going to Blockbuster on a Friday night and you're excited to get that movie that's at the end of the aisle? It's behind that cardboard box, right? And as you're walking up to get that, you had to drive there, you had to park, you had to do all the things, and you're excited to grab that movie, but guess what? Someone grabs it right as you're about to get it, and you're a little bit upset, but you get your second movie. But even if you got that second movie, you went home, and I don't know if you've ever experienced this, you open the movie, you're excited about that one, but then all of a sudden you find out, I just bought a movie, I rented a movie that I don't even want. This is the wrong movie. And then you had to return it within 3 days, and then you maybe had a penalty. Well, that's like the 1031, and I call that transactional exit planning for a lot of folks. It's very limited. It's very restrictive. It often puts them in stuff that they don't necessarily want to own or buy. And so the deferred sales trust is like the Netflix in that you can now sell high and buy low, all tax deferred, never using a 1031 ever again. And the best story for this, what changed it for me when I was at Marcus & Millichap, was a gentleman, I learned about it in 2009, but a gentleman in 2006 sold a property for $20 million. And he deferred all of the capital gains tax and just the deferred sales trust. He put it in the sideline, stocks, bonds, mutual funds, very conservative stuff that wasn't subject to the big swings of the stock market crash. And 5 years later, the bank calls him back and says, hey, you know that property you sold? He said, yeah, well, we just foreclosed on it from that 1031 buyer, who bought it from you. He said, yeah, well, we're just curious, do you want to buy it back? And the guy says, sure, that sounds like a pretty good deal, but I'm just curious, what's the price? And he said, well, about 60 cents on the dollar. So he reallocated the investments in the deferred sales trust into a brand new LLC, and he bought it back at 60 cents on the dollar, all tax deferred with the brand new depreciation schedule. And at which point my brain explodes, because at Marcus & Millichap, we thought we had figured it all out. We were the Navy SEALs of the investment brokerage world, the 1031 exchanges, we were the best of the best, but we didn't know it all, right? And that began the journey of exploring this, knocking over all the false beliefs, actually closing the deals. We've closed 7 of these in the last 40 days alone. We'll close another 70 in the next 40. And it couldn't be busier because Biden is proposing taking away the 1031. He's proposing to take away the stepped-up basis. And the deferred sales trust is positioned to help on all these perfect storms that are going on right now.
That makes complete sense. And we'll dive into like a step-by-step process a little bit later in the episode as well. So we're excited to hear that. So obviously with the 1031 exchange, essentially what you're doing is exchanging one property for another in order to defer taxes over a period of time. So what are some of the tax implications of a deferred sales trust?
Great point. So the first one that a 1031 does, the deferred sales trust does, right, is defer capital gains tax. And let's also define that too. It's somewhere between 30 and 50% of the gain, right? Depending on the depreciation recapture and depending on what state you're in. So let's just say California, for example, you get 20% federal, 13.3% state, a 3.8% like Obamacare, Medicare tax. That gives you 37%. Then with depreciation recapture, you could be up to 40, 45, or 50%, depending on how long you've owned it. 27 and a half years for multifamily, 39 years for commercial. So all of those things, you always got to make sure you clarify what your liability is. And we also start with saying, okay, we want to defer capital gains tax, but really, what are you trying to solve? Like, why are you selling, right? A lot of our clients, they're baby boomers, right? They've been in the business 20, 30 years, and they're tired of the toilets, trash, liability, new Gavin laws, rent control laws, all of the nonsense that they're having to deal with on a day-to-day basis, right? And they just want to be retired or diversified or out of debt, right? Or again, the ability to go back into something when they want to with partners or by themselves. And so we defer capital gains tax is the first part, but the second part, which adds to the ROI of the deferred sales trust, is the ability to defer income tax. And this is really important to understand, right? Because one of the major reasons to own real estate is for the depreciation to offset the cash flow. But guess what? When your depreciation runs out, that cash flow is being taxed. Well, on the deferred sales trust side, not only can we reset a brand new depreciation schedule when we buy new real estate, however, the other part of it though is we don't have to take income from the trust right away. In other words, we can delay it. Kind of like an IRA, guys, right? Or 401k. Think about that. When do you pay tax on an IRA or a 401k? Well, when you start receiving payments from that. Okay, so on the deferred sales trust side, we can defer the capital gains tax. We can also defer the income tax by delaying payments. Typically, we delay for somewhere between 2 to 4 years, and then you start paying tax. So we just did a deal in Alabama for $2.6 million for a client. He had a $600,000 liability. He's selling a business, doesn't qualify for a 1031, but the deferred sales trust, it does. He sold that business, deferred $600,000 of tax. He's also a very high income earner. He's in his mid 40s. So he doesn't need or want any of the income right now. So he says, Brett, let's delay the income for a couple of years. But in the meantime, he used the trust in partnership with the trust. He's building 70 multifamily units in Tennessee, all tax deferred. So again, he got capital gains tax deferral. He's also got income tax deferral. Okay. Guess what? He's getting a brand new depreciation schedule on that brand new property he's buying. Once he has that established, he can turn the water faucet on. Think of it like on and off. As he turns it on, cash flow starts coming out of the trust. But guess what? There's that depreciation to offset it. Okay. So he went from having a 0 depreciation schedule on his business sale, $600,000 of liability, would have been a huge income tax, to be able to delay that and then tax optimize on the way out. So I'll pause there, make sure you guys caught all that.
No, for sure. So I think a big distinction there is once the real estate is bought, you can then use the depreciation from that real estate to offset the income that you're drawing on. But if you were to draw on that income, prior to buying another piece of real estate, then obviously that would be taxed at a different rate. Is that correct?
You got it. And if we would have done a 1031 exchange, although his business didn't qualify for that and he had a 0 basis, guess what? His old depreciation schedule travels. That's why the 1031 is like Blockbuster, right? Because your old depreciation travel is not good. You want a new depreciation schedule, okay, to give you more offset, okay? So that's the beauty of the deferred sales trust.
And real quick before we dive into the next question was if you were to draw on that income, is it typically taxed at an earned income rate or is that taxed at a separate income?
You nailed it. Yeah. So it's ordinary income tax for all of the interest payments that it gets off. So I call it the golden goose versus the golden eggs. The golden goose is the $2.6 million, the original amount. And as the interest, typically these are 8% interest bearing notes. You get a promissory note. That's what you own. You became the lender. You became the bank. It's over a 10-year period of time. You can renew every 10 years past your kids. But as you take off that interest, you'll pay ordinary income tax on this, right? This is not tax avoidance, it's just tax deferral. And most of our clients are taking income pretty soon, from the trust. Now, if you dip into that principal, the golden goose, you'll pay some capital gains tax in that given amount. And of course, you'll pay at the new capital gains tax rate. Like if Biden takes it from 20 to 40, you are risking paying higher. So you always got to kind of weigh that. But most of our clients like to keep the golden goose intact. Even though they owe the $600,000, the government says, we'll give you a 0 interest loan. Okay. You owe it to us as long as you invest it into the economy, into businesses, into real estate, all those things that produce jobs and produce tax revenue. This is why they do this, by the way. It's a win-win for them and it's a win-win for the client. They don't pay interest on that amount, but as they receive payments, they will pay tax. Does that make sense?
It does make sense. Awesome.
Yeah. So what I was taking from it is, so you're saying that within the trust, you can't use those to say like purchase any other securities or anything like that. You have to stick with real estate, or how's that?
It's actually both, right? So in
Okay.
a 1031 exchange, it's like Blockbuster because you have to trade one like kind investment real estate asset for another like kind. It's restrictive, right? You can't
Yeah,
diversify.
exactly.
The whole entity must move. That's why it's Blockbuster. Well, there's Netflix, right? The movie's never
Yeah.
checked out, right? It's ongoing. You can put it into multiple collateral, stocks, bonds, mutual funds. You can put it into hard money lending. You can do a ground up development in real estate, right? You have all of these things with no timing restrictions, right? So that lowers your risk. You can dollar cost average into these different asset classes, okay? And that's really the beauty of this, right? You're selling high, this one concentrated piece of wealth, and you're diversifying it so that if the market crashes, guess what? You've diversified, you're safer, right? And we believe now more than ever, now is the time to get diversified, to get liquid, to pay off your debt. That's the other one too. In a 1031 exchange, it's equal or greater value, which often means equal or greater debt, right? Oftentimes more debt. So it's almost like you're doubling down, right? You're saying, I'm selling high, and then now I'm going to double down and buy higher and take on more debt. And so if the whole thing falls, it falls because I'm so concentrated in one single asset. And we're saying, don't do that. We're saying, pay off all your debt. That's a beautiful thing about the deferred sales trust. We don't have to replace the debt. Debt is gone. So it's like the Dave Ramsey debt-free plan. Debt is gone. Diversify. Liquidity, right? That get your war chest ready to go. When the market hits and there's foreclosures, you are positioned perfectly for the banks to lend to you. You are positioned perfectly to buy deals all cash if you want to, right? With the Netflix way of doing things. Does that make sense, Jeff?
Oh, absolutely.
And like you said, the timing is the X factor, because again, you can wait out the storm in any economic environment, and the fact that you can also buy not just real estate, you can buy those different types of securities within the deferred sales trust. And at the moment in time when you decide that, hey, the economic environment is right for an opportunity to buy other types of properties or whatever, you can execute on that. So
precisely.
that's awesome. So you were referencing you carrying the note. That's kind of the concept that you described. Can you assign whatever terms you want to that type of quote unquote note?
You cannot. And so also let me define the roles here and how this thing is legal and answer your question. So there's really three parties. There's the tax attorney, there's the financial advisor, and there's the trustee. And this is my role. I'm an exclusive trustee with the Deferred Sales Trust, okay? And each of us are separate entities. These are my business partners, but all of us are necessary to execute this business trust. It's a business trust, okay? And so everything needs to be a couple things. It needs to be business purpose. It has to be commercially reasonable. This is why we do 10-year notes and not 100-year notes. Also, it has to be based upon the risk tolerance of the client. So Raphael, if you're doing this and you're married, you and your wife would fill out a risk tolerance questionnaire. And based upon that, that's how and where the funds are invested. You are the chairman and she would be the chairwoman of the bank. And based upon that, we say, look, you guys filled this out. Here's the risk tolerance. That's about an 8% interest rate net of recurring fees, which fees are about 1.5% to set it up, about 1.5% to 2% recurring, depending on how where the funds are invested. And you look at this and you go, okay, this is what this interest rate is. Okay, it's compounding 8%. It's not 50%. It's not 2%. It's based upon mathematical risk tolerance that is assessed prior to the close of escrow, okay? And then an investment allocation is presented to you, and you say, you're like, hey, Brett, I'm more of a real estate guy, or hey, I'm more of a stock market person, or hey, I'm more of a hard money lending. I want to kind of be in between. I want some liquidity and some diversification there, or a mixture of three, okay? And then based upon that, we mirror that up, and that's how the investments are made. Funds never move without your signature. So that's why it's 8%. Now, it could be 7% or 6%, especially if you have lower risk, okay? But we've got to maintain what's called commercial reasonable loans that would be done and over a commercially reasonable amount of time, and then make a reasonable amount of risk based upon your risk tolerance. Does that make sense, Raphael?
It does. And one of the things that you mentioned is deferring the draw. So how long can you defer a draw? Could I say, I don't want to take a draw for 10 years? Or I want to take a draw for 20 years?
Typically don't like to do anything more than 2, right? But even so, when you start to take a draw, you don't have to take the full amount. So you might take, let's say, 4% and let the other, if it was an 8, take 4 and let the other 4 accrue, right? Compound and build. So yeah, we like to stay around 2.
Okay, that makes sense. Cool.
And I'm actually really curious about like one of these deferred sales trusts that you went through and you performed in the past. Like what's one that comes to mind for you that can you give us an example, walk us through it?
Yeah. So we just closed a deal in Palo Alto. It was an $8.3 million primary home sale. And as you know, primary homes do not qualify for 1031 exchanges, right? The person has to move out, get a tenant, redo this whole thing. Nope. So this particular gentleman, he happened to be one of the top realtors in KW history for the entire Silicon Valley for 30 years. The number one, like for multiple years. And he's going, Brett, this sounds too good to be true. How do I don't know about this thing? Do you know how many huge homes we've sold for people and the tens of millions of dollars in tax they've paid? But hey, I'm open to it because I like to do it for my own house. So he had a CPA go through it, all the same stuff. Too good to be true. I don't know. It's too like, okay, they signed the NDAs, they go through it. We give them our references, they do the deal. So we deferred somewhere around $800,000 or $900,000 of capital gains tax. Now realize you have what's called a 121 exclusion if you live in a primary home. If you're married, you get $500,000 tax-free, $250,000 if you're single tax-free. But above and beyond that, he still had around $800,000 of liability. Okay, so the difference between him selling, paying off debt, and paying tax, and the difference between using this meant that the whole deal was dead in the water if it wasn't for the deferred sales trust. And so what I like to, and since you guys are in the real estate profession, right, to tell a lot of real estate, I'm a commercial real estate broker myself, right, still, I like to tell all of those who are in the profession is we're not in the business of selling real estate. I'm not in the business of selling a tax deferral strategy. We're actually in the business of solving problems, right? And the moment you can actually solve your client's problems is the moment you get the listing, is the moment they use the tax deferral strategy. So it's putting these puzzle pieces together and then having a tool like a Netflix version of exit planning that gets them all together. So that's that one. I also want to tie another one right now that's actually a live one. I think it's just really pertinent. It's a cryptocurrency deal, okay? And it's going to be the first cryptocurrency deal in the history of the deferred sales trust, although public and private stock has been used for it in the past. But a couple in Oakland, they bought over $100,000 worth of Ethereum. Well, Ethereum jammed up, right, to 2017 to about $6 million of value. Then it kind of crashed down. Well, guess what? About 6 months ago, it jammed up, but it went even higher than 6 million, went to like 13 million, okay? Now it's back down again. It's kind of this wild, chase. But the point was they did not sell because they didn't have a clear plan with the capital gains tax deferral. Now they do, and they have it in place. And not only are they going to sell, but it's the transformation of not just deferring the tax, but literally taking something and being able to produce cash flow producing assets from it. Let's call this money out in outer space, to put it into investment real estate, stocks, bonds, mutual funds, and never have to work again if they don't want to, right? And that's the power of the deferred sales trust. Does that make sense, Jeff?
Oh, absolutely. Yeah.
Yeah. And it's very interesting the fact that you can do with other types of securities. It's not necessarily just real estate. And that could be a very powerful thing for not just commercial real estate, people who own commercial real estate, because again, you can diversify your assets across a variety of different securities. And then at a certain point in time, if you decide, hey, look, I want to be able to sell some of these and not have to pay a significant amount of taxes, now someone like you comes in and be able to help them sell these different securities to be able to put them into a vehicle that can now pay for their lifestyle for the rest of their life. So that's quite an interesting prospect. So one thing I wanted to ask you, and this is probably something that obviously you can provide, is what are some of the best resources available to learn more about this strategy? Because like you said, a lot of people, especially when they first hear about this, think it's too good to be true. What are some of the things that you provide them to say, look, this is actually the real deal?
Yeah, so I just want to tell you two quick stories. I'll try to make it as fast as I can. And this helped me to overcome it as well, because realize that 10 years ago when I learned about this, we all thought the exact same thing, right? And this particular gentleman I'm going to tell you about, I don't know if you guys have heard of this guy. This guy is a guy named Bill Gross. Have you heard of a guy named Bill Gross?
I don't think I have.
You might not have, because you're in the commercial real estate world. I didn't really know the guy either, but he's kind of like how Mark Cuban is like entrepreneurial business guy, and then you have like big time commercial real estate people like a Warren Buffett for finance and mobile home parks and all that. Well, this Bill Gross guy is the same thing for the financial advising world, and he's very respected, very well known, and they built a company called PIMCO. He and like 5 guys from 80 billion to 1.2 trillion. PIMCO manages some of the largest wealth in the world, okay? And they get approached with these kind of strategies all the time from people who want to bring them on and help them to take it to their clients, okay? Well, five of these guys at PIMCO kind of all retired. They formed 4 of the 5. One guy particularly named David Young formed a group called Anfield Capital. And as a part of that, he got approached with the Deferred Sales Trust 3.5 years ago. And like most people, he said, you know what? I don't know if it's true, but if it's true, it's amazing. I'll take a peek at it. And he didn't look at this thing for 2 days or 2 weeks or 2 months, but he had his entire legal team for 2 years do due diligence, deep dive into the clients, into the banks, into all of the strategic alliances that we have. go through it, sat down with the tax attorney, had his legal team go through it, lay everything out on a whiteboard, sign all the NDAs. And he came back with 2 conclusions after that. 1, that's the smartest person we've ever met, and that's the tax attorney who created this thing. And number 2, we're all in. They're a part of the inner circle to manage money. And you can go to capitalgainstaxsolutions.com and you can watch his interview. And I'm telling you, he's much smarter than me, okay? I'm a commercial real estate broker turned trustee, become an expert in the deferred sales trust. This guy has 30 years in the business of all kinds of things that he's said no to. But for one of the first times, he says yes to the deferred sales trust. And so the question really is this, Raphael and Jeff. If it's good enough for David Young, who ran with Bill Gross, on his right-hand guy, who's one of the most respected guys in the industry of financial advising, the history of probably the U.S., right? After 2 years of due diligence, and he's willing to put his name on it, is it good enough for you and your legal team, right? And you can talk with David. David's like, yeah, I'll talk with anybody. I love to manage the money for folks. It's an option, right? And that is where I want to help you guys understand that it's not just me saying it or just even one law firm saying it, but there's national law firms. There's thousands of strategic alliances. I train financial advisors. I train commercial real estate brokers. We've been through this so much. The track record is perfect. Over a dozen no-change IRS audits, billions under management, to over 25 years. The IRS has seen this, has tested, has looked at it. All of the audits have been no change, but beyond all of that, the tax attorneys, my business partners who perfected this, they provide lifetime audit defense. They stand behind their work. The next part is we work on a conditional basis. So we invite you to be skeptical and invite you to bring in all your folks, because we don't charge you a dime unless you do the deal. And we will literally walk through step by step by step by step, because this is an important thing. In order for you to do the deal, we need to set this up before close of escrow, typically before even the buyer removes contingencies, right? Unless it's in a 1031, then we can save a failed 1031. Okay, so timing is of the essence. So we want to take all that pressure off of you and the folks and say there's no charge unless we perform and you actually close and the buyer actually closes. But for any reason, if you don't want to use it, don't use it, right? But it is that good, but it is proprietary, it is protected. It's not something that we just have, 1,000 law firms doing. There's literally one law firm doing this. And so hopefully that answers the question, Raphael.
Yeah, for sure. And it looks like you also have a podcast that you do some of these.
Yeah, you go to my YouTube channel, you go to my podcast, just search Capital Gains Tax Solutions on YouTube or on iTunes or capitalgainstaxsolutions.com and get my free ebook, whatever you guys need.
Awesome.
And speaking of a book, one of the questions we like to ask our guests, what is one of the most impactful books that you've read? It could be lately or in the past, or something that just kind of stands out for you.
Yeah, so I mean, of course, there's the Rich Dad Poor Dad. Everyone says that one, but I would say Never Split the Difference is probably one of the most recent ones that has been a huge impact, and it's by Chris Voss, and it's really just learning how to listen and how to connect and how to have empathy and really communicate. So I think it's something we can all be reminded of, and one of the things he talks about is mirroring the last few sentences or words or ideas that someone just said. And as you do that with what someone else just said, it's almost like a connection in the brains that say, okay, yeah, he actually heard me or she actually heard me. Now I can feel safe to move on to the next idea or be ready to receive what they're going to say back, right? But too often we're just reacting versus mirroring. And then once we mirror and make that connection, moving to the next part of the idea, if that makes sense. So it's mirroring the last few sentences of what the person just said or last few words or thoughts, if that makes sense.
And not only that, but like you said, mirroring sometimes even their body language. You can tilt your head if they're tilting their head. And, just again, it's very subtle, but it can make a huge impact in the way you interact with those around you. So yeah, that's a phenomenal book as well. That's one of the books that I read probably about a year or so ago, and it really did make a pretty big impact. So that's awesome. So one of the things we like to do at the end of our podcast episode is to ask our guests to provide something to the CRE treasure chest. Essentially what this is, it's a repository of resources we provide on our website that our audience has access to. It's free resources. So just wanted to ask you, what did you have available for us today?
Yes, that's my free ebook, and it's Sell Your Business, Real Estate, or Cryptocurrency Smarter. Basically, it's going to break down 9 steps to using a deferred sales trust to create a transformational exit plan. It's going to give you client testimonials. It's going to give you some samples. It's going to give a big chunk of what you need to know, and it's a pretty quick read. And so yeah, you can. I'll be providing that to Raphael and Jeff, and check it out in the depository gold mine there.
Thanks, man. No, I appreciate it. And seeing some case studies, I think, would be helpful, especially to help illustrate it better for people. I mean, obviously this podcast, you can re-listen to this and watch it, or watch this on YouTube, and you can reiterate it as well. But, having something like that would be very helpful. So thank you for that.
You're welcome.
And so to close this out here, how can the audience and the listeners, viewers, and get in contact with you? And if you want to go ahead and plug your podcast and YouTube channel, that'd be great.
Thanks, guys. Yeah, so you can go to capitalgainstaxsolutions.com, and you can search that on YouTube, on Google, on iTunes, Spotify, all the major ones. And then if you're a business professional, like a financial advisor, business broker, CPA, luxury realtor, commercial real estate broker, syndicator, you can go to experttaxsecrets.com. We've got a hands-on, hey, I'm in the, if you feel like you're in the top 5 or 10% of your game, right? You can get hands-on coaching with me to really accelerate your knowledge of this, because it took me 10 years to figure this thing out, honestly. And I've perfected it. And now I want to give you all my secrets, right? And so we have that coaching option as well. That's experttaxsecrets.com.
Awesome, man. Thank you for that. And we'll include all those in the show notes as well below. So really, Brett, thank you so much for taking your time to be able to talk to us today. If you guys are watching this on YouTube, feel free to like and subscribe to the channel. It really helps with YouTube algorithm and ensures more and more people can hear this podcast. If you're listening to this on a podcast medium, drop a 5-star review and provide a comment in the section as well. Helps us really spread the message and grow the channel. So thanks again, Brett. Really do appreciate your time. And I guess we'll see you guys next time.